Let's get across the market open now. Kyle Rodder joining us from Capital.com. Kyle, good to catch up with you on this Thursday. Now, the focus overnight very much on that latest inflation read out of the States, which did come in line with expectations.
Yeah, almost entirely. Effectively, if you looked at sort of the top line core figure as well, we saw more or less what economists were expecting, which was, a slight pickup in headline inflation, and then, a sort of print consistent with last month, 3.3% on a core basis. So, although it suggests that maybe inflation's just a little bit sticky, that was already the fear. There was sort of concern about upside risks here, especially for two reasons. One, because the data's been fairly resilient, certainly not seeing that kind of deterioration in growth that we were worried about a few months ago. And then, of course, this is sort of factoring into longer term inflation expectations and what sort of base we might be looking at for CPI as potentially inflation starts to pick up next year if Trump can get through his fiscal agenda, as well as tariffs somewhere down the line as well. So we saw the markets price back in a higher probability of a cut December. It hasn't gone away as being the kind of on the balance of probabilities the likeliest outcome for that Fed decision that it will cut by 25 basis points. But now we're going from a 60-40 chance, if you look at the CME's FedWatch tool, to 65, maybe 70, depending on when you've actually looked at the futures markets this morning. And so again, the markets are still kind of betting on a rate cut in December. So slightly supportive for asset prices across the board, although we haven't really seen that manifest in equities. That kind of post-election Trump trade hasn't really regathered steam just yet. If anything, it's taking pause, and we're sort of waiting for the next catalyst.
Yeah, a bit of a fade in the Trump trade at the moment. What did you see in terms of that market reaction with those Treasury yields? Did actually the shorter end came off quite sharply there, and of course the US dollar continuing to appreciate.
Yeah, and I mean, different timeframes, I suppose, that kind of short end, that drop in the short end of the yield curve was very much associated with that, pricing back in the higher probabilities of a rate cut in December, just at the margins, of course. We did see the back end fairly steady, and that is more of a function of those longer term expectations around inflation growth, and that's tied to that sort of fiscal stimulus story. An extension of that too is issuance. So we're still seeing that kind of narrative feeding into the US dollar as well, which is very much associated with moves at the back end of the yield curve, perhaps higher neutral rates, economic outperformance as well. And, the extension of that too is, in a world of higher trade restrictions where dog eat dog, it's a dog eat dog kind of world, that the US economy is the place to put capital. And if anything, it's sort of sucking up capital because of, the impacts it could potentially have on Europe and then also parts of Asia as well. That also manifested in a bit of weakness in gold. We've seen that come back pretty significantly, which is one of those Trump trades leading into the election, which hasn't sort of maintained momentum, really on the basis that the US dollar is pushing the nominal price for gold, I guess you could call it, as well as high yields. Pushing that price of gold lower. So that's another kind of trade that we're seeing there sort of manifest. But all in all, it's still sort of an environment which is quite supportive for the US dollar. Again, that's kind of that, rather than those sort of short-term factors around what the Fed could do next month, it's about those sort of longer-term factors around fiscal stimulus and trade wars and what have you.
Yeah, and of course, as a result, we have seen the Aussie fall back below 65.
Yeah, and more or less that's an even better expression of that kind of Trump trade and trade war thematic. Of course, there's that story we've just mentioned about the US dollar appreciating, but quite naturally the Aussie has dropped as an expression of China's economy, which a part of that is just the disappointment of last weekend's stimulus announcement. We did see the Aussie drop back below 66 cents on that news, but now we've got a sort of situation where the markets are pricing in weaker Chinese economic activity going forward because of the impacts of tariffs and then potentially trade restrictions too. We're going to be entering a world of bilateral foreign relations, which from the market's point of view is really about picking who is on good terms with the United States and who isn't, and whose economy may and markets may benefit or find themselves impacted negatively by that. And then the other element too is that that will manifest in a weaker yuan and might also but from both perspectives that it will weaken growth in China, but also because we might see a bit of a competitive devaluation by the Chinese to sort of offset the impact of tariffs. Both of those factors are negative for the Australian dollar because it will affect our commodity demand. So the Aussie's looking very sluggish here, and of course we're moving into this jobs data today, which will tell us a little bit about maybe the rate path going forward, and will have an influence on the FX market as well.
What are we expecting with that labour data? Unemployment rate expected to stay at 4.1%?
Yeah, I guess one thing is, of course, and we've found this over the last 6 labour force prints, is that there has been economists have had a very difficult time estimating the figures in advance. The last 6 figures have actually overshot expectations, and there's probably 2 reasons for that. One, it's difficulty modelling post-pandemic employment trends, so there's a statistical sort of element to it. But the other part of it is that it would seem that the labour market is relatively robust, despite the fact that we're seeing relatively weak economic conditions in Australia. Certainly growth is fairly sluggish. Today, it's a fairly similar story, around 25,000, give or take, jobs forecast to be added to the economy in October. Unemployment rate remaining around 4.1%, which, it has to be said, according to the RBA's last statement of monetary policy, is below where they thought the unemployment rate ought to be tracking. So stronger than expected. Really, the biggest issue now is sort of assessing, at least in terms of the domestic data, the likely timeline of when the RBA may be able to cut interest rates. That has been deferred over the last week or so because there is that sort of view that that Trump trade will manifest in higher global rates. Australia won't be spared for that, and that first rate cut has been deferred from being fully priced in from around May or so, say the start of the second calendar quarter next year, to somewhere in the middle of next year. At different stages, it's already crept back to kind of September or so. So this data will probably be a little bit marginal. It'll be, again, a little bit like the wage data yesterday about what it says about the timing of rate cuts, but still influential potential for intraday volatility.
Now, of course, Kyle, part of that Trump trade has seen crypto fly. In fact, Bitcoin surging past 90,000 overnight.
Yeah, and 2 elements behind that: lowered regulatory risk, and of course, I think there is a lot of investors out there buying into that on the basis that it is a little bit of a hedge against a pickup in US deficits and a growing public debt load in the United States, possibly inflation as well. If you look at sort of historical precedent, we do often see these end-of-year melt-ups in crypto markets, Bitcoin in particular. And if you compare it to, say, 2016, 2017, and 2020, which respectively saw a 60%, 180%, and 160% rally between the middle of November and the end of December, we could see a Bitcoin price conceivably above $100,000 per token. The interesting element too is that I'm not sure that the, I suppose, casual observer, or perhaps the retail buyer, or the late adopters out there have really caught onto it yet. I was having a look at a comparison of Google Trend searches just yesterday and comparing them to previous rallies. Just what is Bitcoin, or how do I buy Bitcoin, those sorts of search results. And we're not seeing the kind of spike in activity just yet compared to those previous melt-ups in Bitcoin. So we did see the price come back actually fairly significantly over the last few hours, back below $90,000. It'll continue to be a manifestation of the Trump trade, and to an extent as well, monetary policy. But again, not making predictions, but historically speaking, we could be looking at a fairly big melt-up again in crypto, which we might see hit the $100,000 mark before the end of the year.